In today's video, I'm going to share with you a beginner-friendly model that you can all appreciate. This is the first model that I learned that led me to consistency 3 years ago. Ever since then, I've accumulated at least 5 models that have elevated my trading experience. So I hope this model can do the same for you. Now, I spent the last couple of months since I started this YouTube channel building up on topics related to bias, preparing you for this because many people rush to make money before they're ready to tackle the market. It's like going to battle with an unsharpened sword. You're bound to lose. Now, let's get straight into this model. The first thing that you always need to have in a productive model is always have directional bias. And so you have to determine what is the narrative. Has price signal liquidity pool? And if so, then price is most likely to retrace back inside the range. Has price rebalance the favor gap? Then most likely the price will expand towards liquidity. Is price in discount? Then seek higher prices. If price is in premium, seek lower prices. Because this is a reversal model, primarily going to be using reversal patterns, I need you to understand that we do not trade patterns for pattern's sake. And so refer to topics on bias. As I've said before, there's so many things that we've covered already, all dealing with bias. Now, in case you don't know how to determine bias, just head on to those videos that I've shared already. Okay. Now, the time frames that we're primarily going to be using for this model is the daily time frame, which we'll use for a bias and narrative, and the 50-minute time frame is where we're going to be identify reversal patterns. For the 5-minute time frame, we're just going to be using it to refine our entries. Now, this is the protocol which you're going to be following. For daily swing highs and lows, you want to see price trading above an old high or below an old low, and then a reversal pattern forms on the 50-minute time frame, and then price trades to the opposing side of the range. And then for other daily PD arrays, you're going to see price trading to a daily PD array, then a reversal pattern forms on the 50-minute time frame, then price trades to the opposing side of the range. Now I know swing highs and swing lows are PD arrays too, but there's a reason why I have differentiated between the two, from swing highs and lows and other PD arrays. You will see that as we move on. Alright, now some examples, okay? Price trades to this liquidity pool over here, right? Now, as I said before, right, what is your narrative? For this particular case, we see price trading from well, it's bullish, right? And it's coming from a bullish Beverly gap, okay? And price buys until reaches that liquidity pool over there. And of course, already, because of the benefit of hindsight, you see price after taking out the liquidity pool, trading back inside the range and selling from there, right? So the narrative here is that there's this external liquidity pool, this is an external range liquidity, so price is going to move from external to internal, which is this low here. So external range liquidity low here, external range liquidity high there. So price move from external range liquidity to internal range liquidity. We have is a this thing low over here. Okay. Now all you need to do is wait for price to trade above its old high, which it does on this particular day. On that day is when we move on to the 50-minute time frame to see the reversal patterns forming. Now there's a process, okay, to how you determine, or how you identify the reversal patterns rather. Now firstly, you want to see stop hand reversal pattern for me. This is going to be common, okay, but sometimes you'll see, of course, I'll touch on it a bit later, but generally the first thing that you always gonna see is the stop hand reversal pattern. and what confirms it is a close below the low that got liquidity. Okay, now a couple of things. There's so many variations. I've covered that in a totally different setting, but price is in this case here, price takes out this high as well as the daily liquidity pool. That was the stop hunt. Okay, and when price closes below the low that where we had the run on liquidity, then the stop hunt reversal pattern is confirmed. The reason why there has to be a close is because as on this side we have the buy side of the curve and the side of the sell side of the curve. Okay, on the buy side of the curve, what you're seeing is price creating higher highs and higher lows. Okay, now this means, say price creates a high, create a low here. When price breaks here, we can just say this is the stop hunt until we see it close below this. And when price close takes out this high here, we're not going to say this is the stop hunt. You see price went down, but we're not going to see the stop hunt until we see it close below the low here, the low that created that sweep of liquidity, right? So it's imperative that we have this close below the low that created the stop hunt. So close below stop hunt is confirmed. Now you can have an aggressive entry at that point when the stop hunt reversal pattern has been confirmed. But I'm going to teach you how to take trades only after confirmation. Okay, so when I avoid aggressive entries at all, we're just going to take confirmational entries. And so the next step, which will be the failure swing. Generally, you're always going to have the stop hunt and the failure swing occur in the same place for reasons I just spoke. I talked to you about being the buy side and the sell side of the curve. The way that happens is that a complete reversal will have to have both of these two, or will show some type of variation of these two, in a way that stop hunt indicates liquidity being purged, liquidity being taken out, right? But then a failure swing indicates the lack of the inability of price to continue going higher. So we call it the failure swing. So by it failing to take out this high, price is indicating to us, right, that it is unable to go any further up, right? It's been going up, but now it's unwilling to continue going higher. This is why it's best that you see both the two reversal patterns in the same place. And of course, they generally just form like this, right, in sequence like this. And so failure swing, just like the stop hunt, is confirmed only after it closes below the low that creates that failure swing, and generally after the stop hunt. So stop hunt low, when the price closes below here, the expectation is for price to retrace back inside the range to a level of premium in here, and then so from there. Now we're not going to consider this failure swing any time until we see a close below the low here, and that's when we see a close. So now it's a failure swing, and of course the failure swing, of course, I think by now you should know how a breaker block is formed. So a breaker block generally is formed by a stop hunt, okay, with a high taken and then a lower low than this. This will create the breaker block. So the stop hunt reversal pattern in our case would create the breaker block, while the failure swing would create the mitigation block. Because I want you to primarily focus on the confirmational entries, which will take only after seeing a failure swing. You want to see price selling off of the mitigation block, okay? Only, of course, if the mitigation block is in premium or this kind of flag, depending on whether it's bullish or bearish. Now I'm going to show you why, because sometimes generally what the entry is actually supposed to be on any PD array, or let me say in a premium PD array on the failure swing leg. Okay, let me say it again. The entry is supposed to be on the failure swing leg in the premium if it were, well, of course, we're bearish. But if we're bullish, it's gonna be in discount, right? So the entry is supposed to be on either order block, heavy gap, whatever, as long as it's on the failure swing days. Because after we close below here, price will usually retrace back inside that range and then sell from there. That's the time for your entry. Now I'm saying that in this case we have the mitigation block in premium, and that's where price is gonna retrace up to and sell from there. Very nice. Okay, this will be the end of it. No need to go to 5-minute time frame, because 5-minute time frame we only need there to refine our entries when the price action on the 15-minute time frame isn't that clear. And of course, to avoid any further confusions, because there's so much detail that you get in the lower time frames, stick to the 15-minute time frame. And generally, when you combine what we just did, okay, with narrative, you see that price taken is coming from external range liquidity to inside range liquidity, and our entry is actually right there on the 15-minute time frame. Stop loss will be right there, and this will be the take profit. So this is how it looks at the end of the day. Then for the next example, I just did this one where we took out an old high. Now we're gonna do with an old low. The price inside old low goes back inside the range. Okay, let's see what formed the price up to stop hand reversal pattern, right? So like I said, usually you're gonna have sell side of the curve, then buy side of the curve. And the way that happens is, in order for us to determine what is the stop hand, we have to see a close above the high that creates the stop hand. So it was never any of this, because if it was this one, we want to see a close above this. If it was this one, we'd want to see a close above this high. But it was this one because we saw it close above it here. Now the thing is, the great thing about this, we're waiting for confirmation. That's the great thing about this model. You wait for confirmation, right? You're not trying to rush price. You're not trying to get ahead of yourself. Now, for like I said, the aggressive entry will be taken after the stop and reversal pattern has formed, but I want us to take confirmational entries to play it safe, and so you have to wait for the failure swing reversal pattern, which is only confirmed after you see a close above this. As I said before, the stop hand will create the breaker block, while the failure swing will create the mitigation block. This is where price brought from, and the target is always going to be previous daily high. Okay, and the Zylogs, when you combine it with narrative, prices come from external liquidity, and then it's going to buy all the way to internal liquidity. At that point, this is where the entry is on that mitigation block, and stop loss will be below that mitigation block, and as you see, price reach all the way to internal range liquidity. So the context is taken from the daily, the entry on 15-minute time frame. Never forget that. Okay, this is how we're going to build high probability trades, by not trying to force the pattern on lower time frames. Let's look at the example now. So we dealt with price taking out swing highs and swing lows. Now we're dealing with PD arrays. So the first PD array we're going to deal with is a fair value gap. So price trades into a fair value gap and then buys from them. And in this case, we do not have a stop hand reversal pattern. Like I said, there's variations to this. Now, low lows and no lows and all that, this could be considered the stop hand over here, but as you can see, it's not satisfactory, right? And again, there's nothing wrong with it. Actually, it's actually good, because after all, we want to see the failure swing after the stop hand, right? So we trade into fair value gap, create a failure swing, price fail to create a lower low here. Okay, they're not equal actually. This one is 10 ticks above this one, and so because this is always the one that comes after the stop hand, and so it's good that we see it here. It's only confirmed after price closes above this high over here, and when price closes above it, right? Mind you, all this time I've been making out the ranges, right? From the Philistine to this high here, that will be, I'm always showing where premium in discount is. So this order block is in discount, and so after price closes above and confirms the Philistine, we trace back to discount OB. Notice this time we don't trace to the mitigation block. Why? Because it's not in discount. Okay, it's not in discount. Let's target, so it's going to be previous daily high, and generally the where we close off or the entire position is always going to be the higher time frame targets. Okay, and so to see price buys, this is where the entry is. Stop loss is somewhere at the low, and then boom, price buys all the way to external. So this is when you combine, when you look at the narrative, is that price traded into internal range liquidity and then expand it to external range liquidity. So move from internal to external, then external to internal. We dealt with this trade here, right? Now we're dealing with this one, right, from here to there, because we're moving from a fair value gap to liquidity pool. All right, let's look at another PD array. This PD array you're gonna look at is the breaker block. Okay, so now price trades into a breaker block. Okay, you see high, create a higher high, and create a lower low over here. So we super high, then we break below this low, and then we close below it. So this is a confirmed breaker block. Now generally I want to see breaker blocks forming at the highs and lows of ranges, but this one formed internally, but it was valid in any case. And so let's look at that and see when price closed below and came up there, and see if we can see a reversal pattern for me as price reacts on that breaker block and expands. So as always, following our rules, we want to see a stop hand from me first. Stop hand is always going to be confirmed with price closing below the low that creates a stop hand, right? So why when this one, okay, this one did not actually trade into the breaker, so let's start with this one. So create the high, low, then a high, high. So we trade into the breaker. We've say taken out this high, right? So why would we not consider this the stop hand? Because we did not close below him. All right, let's move on to the next. So high, low, then high, high here. So when we take out this high, why wouldn't we consider this stop hand? Because we have not closed below this one. Now before we could come and close below here, we create a low and stop hand this high. And so when we close below this low here, this is when the stop hand, the reversal pattern is confirmed. And when it's confirmed, the aggressive entry is going to be in premium of this leg, and that is on that order block. But as I said, let's wait for confirmation. So confirmation, we want to see a Philistine forming. Now Philistine is going to be formed primarily when that low there, right? When price fails to take out this high, it's a signal, it's a confirmation that price is unwilling to continue going higher because it's been creating high highs and higher lows. So question is, when price trades into the breaker, will it continue going higher and break or close above the breaker, if you will, or will it indicate us that no, it's unwilling to continue going higher, but rather it wants to go lower now, hence reverse, right? A close below that. When price fails to take out that, you want to see the close below that low. And so see, even in this price section, price is not actually close below. We want to see an actual close, which is right there. Price close below here, and then boom, we see a retracement up to a fair value gap over there, and then sell from here. Okay, and the target, so it's going to be previous daily low. The first target is also going to be previous daily low. For those who are intraday traders who do not have the or who would rather not hold price for a really long time, because this is one of those models really where you can really have some massive trades. Okay, so but I want you to notice that from the Philistine down to where price retraces back inside, this is where premium is, and that mitigation block is in premium, so by price sold from the fair value gap. Okay, now in fact, on the next day, price actually trades up into that mitigation block and sells from there. That shows that this is not random at all. Okay, and then this is how for the last PD array, we're going to deal with a daily block, a daily order block, where price trades into a daily order block, right? So we dealt with this couple of setups that occurred here. Now I used the recent price action just to show you, that it actually still works, it's still valid even after all these years. And so this is the first order block. I started here. Now all I'm seeing is price was actually just reacting to fair value gaps, fair value gap over here, and then liquidity pools. But this is the first order block. This is the closest order block that I can find in price. And so let's dive deep into that. Now, of course, notice before we move on that if there's a reversal there, see how long that trade actually took, or that sell from that order block actually took. As always, protocol is the same. We want to see if a reversal pattern first. If not, we want to see a failure soon. Now, in this case, you only see a stop hunt, right? In that we don't have a high that is purged before price closing lower on the 15-minute time frame, but actually on the 5-minute, this down candlestick here is actually a swing. Okay, on the 5-minute is a swing here, the price goes high and swing like that. So in the 5-minute, you actually see the stop hunt, but no matter, right, we want to stick to the 15-minute time frame to avoid too much clutter of information that we'll get on the lower time frames, because this model is all about longevity, okay, as opposed to accuracy. But it's very good, and especially in catching those kind of trades that will really take a long time. And so considering that the Philistine is always the second thing that we want to see after, always, we want to see it come in after a reversal pattern, even if it forms is the only thing that forms. That's actually pretty cool, because then the reversal is confirmed nevertheless. Okay, so it closed below the swing low over here would be the confirmation of the stop on, right? And then when price fails to, because all along we've been going high, right? When we fail to create a higher high, that failed swing is only confirmed when we close below the low that creates that fail. Okay, that failure swing there, that's failure high. So when we close below here, that is a confirmed failure swing. And so we want to see price trading up in this range to a PD area and sell from there. That PD area can either be mitigation block or an order block or fair value gap, whatever it is, as long as it's in premium. Now this case is special, okay, because there's a couple of things that happened. One, what you to notice here, when price goes high, is it high, low, high, 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 low? Then this high, we purge this high, right? We see this high, and then we close below here. That's a mini, or that's an internal reversal pattern. This is a stop hunt reversal pattern, right? And so see how after closing below here, price traces up and sells on this order block. Although remember again that this forms a breaker block, so this is actually a breaker. So price actually, the bodies of, see how they close within the breaker. It's only the wick that touch the order block, but so there's a breaker block over there, and then this here failure to go above there. When we close below here, then this becomes of a failure scene. So it's a stop hunt and failure scene. So this is like a mini internal reversal pattern within that reversal pattern. So this would be the failure scene. If this is a failure scene, then this is the mitigation block. So we have a bearish mitigation block, a bearish order block, bearish family gap over here, and there's 3 up candles, a bearish order block. So, and then there's a daily order block as well, bearish daily order block. So many confirmations, so many confluences to sell. Why wouldn't you? Right? And exactly this is what happens, right? Price sells on that exact area there where we have this family gap, this order block, this mitigation block, this breaker block. It sells. And as you've seen, this was the long time sell that took place from that bearish order block over there. Okay, so pretty enough, easy enough. What you're gonna do is you're gonna backtest to prove the validity of the model. You're gonna forward test to prove the consistency of the model, and you're gonna collect data to prove the efficiency of the model. But this model is easy to lose objectivity because it relies on patterns, but you cannot go wrong if you have a clear bias. Trust me on that one. I've kept it as clear as possible. I believe even noobs can get it. So just share this with someone and help them bridge the gap between struggling and consistency. In my personal opinion, synthetic indices are the easiest markets to trade. You cannot convince me otherwise. Until the next one, cheers.